Okay, welcome to the blog for Wednesday the 1st of August, start of a brand new month, day 38 of 65 of the Compound Effect Challenge, making forward progress every day, applying my edge and method. And again, the focus is really on just creating such a systematic approach that's very much all about being a model as opposed to, or a model that's you take into the marketplace as opposed to myself or as opposed to the individual trying to make decisions during a lower market. The more you research this, the more you understand this and look at what really works in the marketplace, the more I realise that it's just how important this is. And at the end of the day, just get to a situation where every time you take a trade, just should be just no hesitation whatsoever. It's just you take the trade, just absolutely knowing that your risk model that you've created, and also your the way that you position yourself as far as your trading, and it should be take over. And at the end of the day, just lose the focus on that it's all about the entry, and focus more on what wraps up this system, or what's the perimeters around this system, and making the contracts work for you. And that just seems to be absolutely the way to approach this. So here it is, the system, 5-minute systems, 3 strategies, continuing trend strategy, basing that on some major key levels in the market, and just really breaking that down to exactly what I'm looking for. Again, just keeping very much in line with the 5-minute strategy of 5-minute buys and 5-minute fades, so making sure I'm sticking with the overall trend of the market. I know sometimes with the momentum there's a tendency just to use key levels, overuse them. I know for myself, just really focusing on going, okay, well, is this a selling area or a buying area, and just really approaching it that way, and just making sure I stick to the key levels and not over trading them. Strategy 2, breaking the high and the low points. Again, using price action, and every time the market approaches its highs or its lows, understanding that that's a fantastic opportunity to trade, and just having a very systematic approach to that. And then strategy 3, the pivot strategy. I love this strategy because of the fact it picks up on new trends quite early. So whether it's a reversal breaking through an area that's failing in one direction, looking to take advantage of basically the new direction forming, or whether it's a directional picking up very early on a new trend, it's really consistent to looking at breaking a certain area in the market. Alright, so here we go. So FOMC announcement day. You can see from here on in, just crazy markets. So shut down the system there. As soon as you start seeing candles like this, especially it came at 2 o'clock, the announcement today, so 2:15, but it's certainly not looking for anything in this area here. Just shut down the system because it's not the appropriate market to be doing. It's a great day to almost have if you have the opportunity to have a rostered day off, really. Or sorry, not rostered day off, rostered afternoon off. There's certainly opportunities in the morning time. So and I was very much aware of this, if all of a sudden there was a major reaction to this news, I was just going to shut the system down and not take another trade, and it was very likely that you're going to get a big reaction anyway because of everything that's happening in the world with the economy at the moment. So on the daily chart, spoke about potentially this support area holding, but if that didn't hold, then it's likely to get some pressure down to this 50 something region because of the support line and also the trend line there. But the daily charts, like I say, they're very much longer terms, and sometimes not really giving a great idea of what's happening in the marketplace. That's where the medium term markets come into play. So here's the particular day looking at here. Leading up to the day, previously, remember, we had this real breaking down through these support levels and some real momentum on the medium term markets. Then they started popping back up. This is an area where they really should hold and push down lower from, which they started to do. But then as the cash market was opening, they were getting above that level. So certainly approaching these open, I was prepared for the market to go both ways. Had a thought that we had potential to go upside and also downside. But then as I continued to watch this 15-minute chart, it became quite obvious, especially when it came up and bounced down off that area again. But that was around FOMC that that there's certainly some downward pressure forming, and you can see there's a trend line on the downside now. So just a really great way to use this chart as an idea of the current direction of the market, and also great for exit strategies as well, so where you believe the market could go to once your trade gets going in your direction. So all up today, 3 setups that I was potentially looking at, and of the 3, 2 got an actual fill into the marketplace. So the first area I was looking at here, which didn't get a fill, was the directional breakout. So again, this is the one that I spoke about, through looking through my risk models and playing with some of the variables, looking to really increase the expectancy, so increase the average size winner, going for bigger trades. But as a result, we'll see the strike rate drop off a bit. But it's certainly one that I am looking into and playing around with the figures with that one. So here's the sideways channel. We started pushing down. All the other markets were going down. So if the market pops back up, look for this area to hold and push down lower. So just to show you on the 1 minute chart, so 77 is the region here. So you see we push through it, we pop back up, hit it here, and from there it pushed down 7 ticks and then come rebounding up and pushed up through. So it flashed up my order there, didn't actually fill me. Eventually the trade would have ended up in a negative one tick situation, because once it's gone like that, would have moved the stop to 1 tick above the pivot, knowing that if it comes back it's going to be stopped out and keep pushing through the area. In the end, no fill, but certainly close. Looking at this too, opportunity for, haven't used it yet, but with my reversal setup, with an area like this, and it should really hold and keep on pushing lower, then all of a sudden when it comes charging back in the opposite direction like this, and if all the other markets are pushing through this area, very likely to get a continuation through that area. So an opportunity to potentially look at a reversal trade there. Haven't got the setup or the information for it at the moment, but we'll look into that. So that particular trade, no fill. From there the market's pushed up higher, and again, actually, just before I move on, just want to make a point about these lines here. Obviously they're key levels in the market. At times before I did have them different colours just for this blog, and I'm going to keep them all the same colour just so there's not too much going on the chart. But just understand that these key areas are basically, most of them, I'd say 80-90% of the lines are based on the 60-minute chart, and they're developed at the beginning of a week, and then from there looking for those markets, those areas to keep playing out in this market. I do add to them if I see a significant area on the 15-minute chart. Each day I'll check the 15-minute charts for significant areas, and if the 60-minute chart just doesn't quite pick up on it, then I will add that in. And also, I do, these lines aren't set in concrete. I've been playing around with the idea of what to do, whether I set them and leave them, or let them waver a little bit. So what happens is, depending on the area, as we're approaching the area, based on price action, use this as a guide, but knowing that it can slip 1 or 2 ticks as far as changing the actual location of the line depending on what the market's doing leading up to the region. So this is a good example of the continuation, momentum trade. I used it, even though it's a loss, I did use the key level here. Let me break it down on the 1 minute chart. So we go, just draw on a few lines on the 1 minute chart. So this solid line here, that's the actual key level in the marketplace. So coming up to it, what I'm looking for is, this is a new trend. So let me take a step back. If you're looking at this chart in an overall sense of the chart, we've pushed down, we've got this major change in direction, we've broken up through this level that I was expecting to hold on the downside. Momentum is back on the upside now. So, from a 5 minute chart perspective, expecting some sort of fade setup to come up in this region. So, I'm not waiting for the indicators. What I'm waiting for, or looking for, is it to enter, due to how I approach it, my personality, my style, and that's getting above a support level, coming back, using that support level as a base to continue on with the current trend. So obviously I'm using this key level 78.50. Okay, so we're coming up here, all of a sudden momentum's changed, pushing up, watching this level. Now, as we're approaching this level, seeing what price does around this key level, and just making sure I'm picking up on the the exact price action level. So based on my rules, it needs to push 6 or 8 ticks past the region, depending on the momentum as to whether I choose 6 or 8 ticks. So this particular case, a lot of momentum driving through this area here, breaking significant area, just looking for it to push through 6 ticks. So this originally was the area, looking for it to push through 6 ticks from there. When it came down, popped down like this, and then pushed back up there, that creates quite a, this is what I mean by price action. If it just kept going up straight through it quite easily, then I don't move the line. The fact it pushed up, come back down, bounced, and then continued up through the line. Now that this line changes just for this period here, it changes down to here. Okay, again, trying to keep it very systematic, but it's very I explain it very clearly in my system. that, knowing that if all of a sudden it pushed up and I look to buy off this level, that there's going to be some pressure and it's going to come down and look to get to here, and it's going to put my stop under a lot of pressure. So just common sense, or probability is that I need to take the order down at the actual price action level, which is down a little bit lower. Okay, so now once I've seen that, I'm saying that this is the line. So once it's pushed through 6 ticks through there at least, which it's done, I'm placing the order. Down it comes, picks me up. It actually went 5 ticks this one. So I'm not currently doing it, but I'm looking at taking contracts out at the 5 tick or 1R level. So this one here, I don't. So because I don't actually have the actual order there yet, I'm just recording what happens because it's gone 5 ticks exactly. Can't count that as getting out as far as part contracts because it's only gone 5 ticks. I'm not sure whether there would have been a fill there. Probably not. Needs to go 6 ticks to guarantee it, unless I have a physical order there. So went 5 ticks. Wouldn't have got to the 1R contract level, and then from there to push down and end up stopping out. Before eventually holding and pushing up higher, but overall the area just didn't quite hold like I expected to. But this is the sort of thing that how I want to approach it is just like going, okay, the market's pushed up here. This is clearly a momentum setup for me, or a 5-minute fade setup for me. This is my price. Putting it on there. This is the way I'm going to approach it. I'm going to take some contracts out of 5 ticks, or however I decide to approach it, and just letting it go, and just being trusting the system and trusting the model. So whereas that's the stop out within the momentum trade there. From there, I'm still looking on the upside. So again, breaking the charts down as to how they look. So we had a downtrend, momentum change pushing up. This is just a pullback that I was looking to hold and push higher. It's come a bit lower. It doesn't mean that all of a sudden the sellers are taking back control. So you can see it started pushing back up and holding some support levels. So if you look at this, what I'm seeing is trend, pullback, pushing up, and what happens when you get a pullback push up like that? That's a 5-minute buy setup. So again, I'm not looking physically for the actual indicators that cross for my 5-minute buy. I'm looking for my version of the 5-minute buy, which I call a 5-minute continuation. So what that is, I need is to push up, pull back, and get a continuation back to what will potentially be the highs. Okay, and for me, continuation needs to be based on a key level. And again, it's this 78.50 level, so I need it to push through at least 4 ticks this time and get a bounce and get a continuation off that. So I'm not looking, it's not like it's a momentum trade where I'm using that as the actual base. I'm just looking for it to push through, continue through that level. So therefore a small amount of movement through, just enough to get through that level and give myself the most, the highest probability of it holding and continuing with that, the continuing trend. Therefore the name continuation trade. So to break it down on the 1-minute chart, so this is it here. So this is the area we're pushing up, looking to use this line as an area the market's going to hold. As we're coming up to there, I'm noticing that price action is dealing within a 2-tick range. So you can see that it's also dealing around the 78 level. So as we're approaching, going, okay, once we get 4 ticks past 78 or 78.50, one of the two. As soon as we get 4 ticks past it, that's when the order goes on. Okay, so for example, if we go through 4 ticks and then starts to turn around, I'm placing the order at 78. If we go through, keep going up, then I'm prepared to place the order at 78.50 to make sure I get a fill. But seeing this more as the zone, there's a 2-tick zone there, which I'm using as my continuation area. So eventually the market's pushed up, 4 ticks past it, orders come back, picks me up here, and this is where I buy. It dealt sideways. Eventually went 8 ticks exactly again. I'm not sure what it is with all these break-even trades this week, but it's gone 8 ticks before coming out and stopped me out for a break-even trade. So that one break even, and then of course, directional setup. So what happened is, when I'm looking for the market to basically show a change in direction and trend, so as the predictive is crossing down here, this looks a little bit like a directional setup, but there's not enough momentum with the trade on the downside there. And of course, I'm also already in a continuation trade at that stage as well. But the fact it came down so hard here, that's signaling that market's coming back, looking to hold and get a continuation. What I want to see is more like this level here. It sort of comes down, pops up, comes down. As soon as this pops up, makes higher highs, that cancels the trade as far as the direction. If this had been contained within the highs here, and as soon as this predictive average crossed down, I would have been looking at a directional sell. But so this one cancelled out because it popped up, broke the pressure by making high highs, and this one here not a directional either, because just hasn't got compactness within the setup. So that's a break even and a loss for the day. Again, just in regards to risk models and taking the exact same system and having a look at the different ways you could approach it with money management. I just again want to give a bit more information about that, because it's certainly something I find useful. Say for example today, as is, the way I approach it, I had a 4-tick loss. Again, if half of the contracts had been taken out at 5 ticks, would have been a 2-tick loss. If a third of the contracts taken out at 5 contracts, would have been a 2.5-tick loss on average. So, it would adjust it because this break-even trade would have got a bit more out of it. Of course, that loss did go 5 ticks, but I didn't count that because I'm not sure if I would have got a fill there at the 5 ticks. Of course, if they had just got to the 5 ticks, it would have completely changed this area, but didn't count that. Overall for the week, I'm doing some figures on the week. So, as is for the week, and this is not taking into commission, this is just raw figures. As is for the week, I'm up 4 ticks. Okay, if I had taken half the contracts out at 5 contracts, I'd be up 12.5 ticks on average per contract. So that's a 2-point difference there. And then on taking a third of the contracts out at 5 ticks, would have been up 11.5 ticks. So that whether you take out a half or take out a third, it seems to be producing roughly the same figures. But again, must point out that obviously it really it's appropriate for this week because of the fact that there's been 4 break-even trades and also 2 losers, and so far just had the 1 winner. Other weeks when there's say like the week before, 4 winners, 1 break-even, 3 losses. Obviously, something like taking out contracts at 5 ticks means those winners are going to have a lot less of an impact. So that's why it's important to include it over a longer time frame. From a psychological point of view, taking out 5 ticks and making sure you take some sort of profit is certainly going to be helpful. But I think there needs to be two ways to approach it. One is, yes, taking out contracts early at 5 ticks or 1R, but there should also be an option to let some other contracts ride and let your winners become bigger. I was, this book again, reading that book, Trade Your Way into Financial Freedom. He talks a lot about that, and I've listened to quite a few traders recently that talk about it, just giving yourself the best opportunity to have luck. Luck is not just, luck is something you can be prepared for, but at the end of the day, if you're prepared to cut your losses and let your winners run, you're opening yourself up to take on luck. You don't ever want to be in the situation, they call it the black swan event, where you're in a situation where what some people do, and it's a very, very risky approach. It's a very much a casino approach where they bet on the more times they lose, they think the more likely it is they're going to have a winner. So as they're losing, they increase their size or their contracts, just expecting that winner to come and then all of a sudden make up all those losses. And then as they're winning, they decrease their size. It's a really bizarre way to approach it. Many traders actually do it, and some professionals. Okay, it's a really as far as approaching the market, it's dangerous, because saying the black swan, meaning worst case event happens, then you're going to blow yourself up. If you approach it from the opposite direction, and if you're quite a sensible trader, low risk trader, you should be doing the complete opposite. As you're having winning streaks, adding to the contracts and growing your account bigger, and really increasing those winning streaks by adding contracts to it. But then as you're losing, look at reducing your risk level. Okay, and I don't know what the name of it. There is a model based purely on that explains how when you're winning, add, and when you're losing, decrease, and that's a very risk-free way to approach it. Then of course there's the opposite way to approach it as well. So something definitely to keep in mind. So anyway, guys, it's a wrap up for Wednesday. Back on Thursday.